Hello everyone. In today's video, we are going to do a simulation that is very similar to the one you are going to see on the CPA exam. The topic is income statement and the simulation is about multi-step format preparation. As you may know, this is the most common format for the CPA exam, both on the multiple choice and the simulations. They like to ask this format more frequently. And we're going to go step by step. We're going to review the exhibits and I'm going to show you a couple tips and what to look for. Let's get started. Okay, as you may know, in the exam, you're initially going to see the question and you are going to tabs that you can see the exhibit. So we'll try to make it as close as possible. So here in our scenario, we have a company, TechFlow Solutions, and you are the controller of this company. Your primary objective is to prepare a GAAP-compliant multi-step income statement for the year. That means we must correctly classify every revenue and the expense item. And for this one, we have two critical pieces of information. First, you can see that there was a discontinued operation, a retail division that sold on October 31st. And the second one, the effective tax rate for this company is 30%. So here, whenever you see the discontinued operation, remember we always report it separately and we also report it net of tax. So this scenario requires careful attention and the proper placement of every line item. Now let's start looking at the documents to work with. Okay, to prepare the statement, we need to review the exhibits that contain the raw data. So we are starting here with the adjusted trial balance on our exhibit 1. Okay, when you look at here, this list contains all the accounts that we need to construct the income statement. And if you look at here, you see everything is in a mix. So we have standard operating items. You can see here we have a sales revenue. We have cost of goods sold here. But we also have stuff like non-operating items. As you can see, we have some dividends revenue. We also have some interest expense here. And then also we have some pre-tax figures. If you look at here, both for the loss from discontinued operations and for the gain on disposal of. Okay, basically we must carefully pull these numbers and place them in a correct sections of our multi-step statement. Now let's take a closer look at the trial balance data. Okay, now let's look at a closer look to our trial balance. So this is our source document and every number you see here must be used and classified correctly. And now look closely at the non-operating items. We have dividend revenue here. Let me find my pen. We have a dividend revenue here. And we also have gain on sale of equipment. So both dividend and the sale of equipment, they are not part of their core business. So we need to place them under the below operating income. Also, if you look at here, you see the income tax expense for the continuing operations also calculated. We need to calculate the tax effect for the discontinued operations for ourselves. As you can see, we have this one that was reported pre-tax. And so the biggest challenge here is basically getting all the classification right. Okay, so now we have this raw data. Now let's outline the steps and start constructing the statement. Okay, and here is our three-step process, how we are going to construct our multi-step income statement. And the first step, we are going to calculate the operating income. How do we do it? We basically calculate the gross profit, then we are going to deduct operating expenses. which are selling and administrative expenses. On the second step, we are going to add or subtract the non-operating items, the things in the previous trial balance you saw, the interest or gains, things like that. And then we are going to apply the tax expense. Remember, in the multi-step income statement, we first add the values, then in the end we calculate the income tax expense, except the discontinued operations. Remember, there were some discontinued operations, but they gave us the pre-tax information. So we need to calculate the net of tax impact for those discontinued operations. Okay, so we began the income statement with the most fundamental calculation, which is the gross profit calculation. This step is critical because it isolates the profitability of the company's core product or service before any other costs. And we take sales revenue and subtract the direct cost of the sales. In this case, it is cost of goods sold. The resulting profit tells us how efficiently the company is producing its product. And remember, we are only looking at the operating revenues and the direct costs right now. As you can see, we are ignoring things like interest or dividend income for now. We're going to deal them later. Now we have the information about the gross profit. Now let's move to the next layer of costs. Now we calculated the gross profit. Now let's take a look at the operating expenses. Okay, so these are the costs. They are necessary to run the business day to day, but they are not directly tied to production. I usually think of them like the selling, general, and administrative costs. And the key distinction here is what to exclude. So we must separate these core operating costs from non-operating things like interest expense or gain or losses. So we are not going to mix them. So when we look at here, so we already from the trial balance, we got the sale expense information and administrative expense information. So here we can calculate our total operating expenses. You may ask, okay, why interest and those gain or losses are not part of operating? Because remember, the interest is a part of the financing activity. It is not an operating activity. And for gains and losses, it's the similar thing. They are the parallel activities. What I mean by that, so this company is not in business of selling those assets. This was one-off thing, and that's why they are not part of the operating. Here you can see step 3 bring us the operating income, which is arguably the most important measure of a company's performance. We take the gross profit, we calculate it, and subtract the operating expenses we just identified. And this figure shows the profit generated purely from company's primary business activity. It's a clean look of operational efficiency. And here we intentionally exclude financing costs or like interest expense and investing items like dividend revenue. It's because they do not reflect the success of selling the core product. Operating income is the foundation before we consider those parallel activities. Now, since we know the operating income, we are ready to incorporate those non-core items. Now we move to step 4, where we account for all non-operating items we previously set aside. These ones are the parallel activities, investing income like dividend revenue and gain on sale, and financing costs like interest expense, like all of those you can see here. In this specific example, the non-operating items perfectly offset each other, which is rare but possible. The result of this step, income before tax, the final profit figure before the government is basically the final profit figure before the government takes its share. This is the amount we use as the base for our calculation. You can see it here. Okay, now we are in the final steps for the continuing operations. which is the calculating the income tax provision. We use the income before tax figure we just determined. You can see it here. We then applied our effective tax rate to this base to calculate the tax expense. This is an application of intra-period tax allocation, meaning we are allocating the tax expense to the income that generated it. Remember, this tax expense applies only to the income from continuing operations. We will need to keep this figure separate as we move on to the final, more complex section of the income statement. And here you can see we reached the final step in our income statement preparation. Step 6, discontinued operations. This step is critical because it applies the net of tax rule. This rule applies to both to loss from operations and the gain on disposal. So when you look at here, notice that $40,000 pre-tax loss gets a $12,000 tax benefit. So as a result of that, our net loss is now $28,000. And similarly, you can see here we have a $20,000 gain on disposal, and that's reduced by $6,000 tax expense. And as a result of that, we have a net gain of $14,000. So the key takeaway here is that discontinued operations are always reported net of tax, and they appear after income from continuing operations. The way to remember it, if you were the reader of those financial statements, you don't care as much how much money they make by selling some asset. You care about what's their core operations. So you can think with the same logic. Anything like that from the discontinuing operations, things like that, they are going to below. So this separation helps us to helps users to predict future performances without the noise of a business segment that is no longer there. Now we can assemble the final statement starting with the continuing operation section. And here this slide presents the top half of our final income statement, focusing only the continuing operations. We taken all the steps we completed earlier and put them into the formal GAAP structure. You can see the clear separation between the operating income and the non-operating items, other revenues and expenses, as you can see here. This structure is essentially for the analyst to determine the company's core profitability. So after subtracting the income tax expense, we calculated step 5. We arrive our income from continuing operations of $157,000. So this $157,000 is the baseline for what the company is expected to earn next year. Next, we will add the final pieces to discontinued operations and all the important earnings per share calculation. Okay, now building on the previous slide, we now complete the income statement by adding the income from discontinued operations. We start with the $157,000 income from the continued operations. Then we subtract the net loss, and then we add the net gain, and sum of those are equals to $14,000 net loss. And this brings our net income down to $143,000. But we are not done yet. The statement isn't complete without the earnings per share disclosure. Remember, earnings per share must be shown both on the income from continued operations and the net income. I'm just going to repeat it here. Earnings per share must be shown for both income from continuing operations and net income. So this level of detail ensures the full transparency for investors. So this one I repeat a couple times because I know it gets confusing, because as the student's logic, we say, okay, why we are separating core business and non-core business, but when it comes to earning per share, we take everything. This is required for the full transparency for the investors, basically. Here you can see the number, and you can see that we calculated them both separately here. So now we finish the statement. Now let's review some of the strategic key takeaways for the exam. Okay, so we just did a very common CPA exam simulation. It highlights 4 non-negotiable concepts you must master for the exam. The first thing is classification is king. You must correctly separate what is operating expense, what is non-operating expense. The second one is we always apply the intra-period tax allocation, meaning tax follows the income for each major component. The third one is about the discontinued operations. They are always reported net of tax, and they are placed below below income from continuing operations. And finally, earnings per share. This must be disclosed both continuing operations and net income right on the face of the statement. If you nail these 4 points, you'll succeed on any income statement task-based simulations. Perfect. This wraps up our comprehensive income statement simulation. We walked through every step from calculating sales to reporting earnings per share. The next major simulation in our series will be a statement of cash flows, specifically using the indirect method. Mastering the indirect method is crucial because it requires you to understand tax relationship between the income statement and the balance sheet. Make sure to like this video and subscribe so you don't miss part 6. Thanks for joining us.